You know that feeling, right? Your inbox, it's just packed with headlines about the economy, especially inflation. Feels like every single day there's a new report, a new forecast, and uh, honestly, trying to figure out what's really going on with your money, it can be incredibly overwhelming.
Oh, absolutely. It's like trying to drink from a fire hose of financial news. And often, these reports are written for market analysts, maybe not directly for you, the person just trying to make sense of daily life and, well, future plans.
Exactly. Our goal here is really to cut through all that noise.
Give you the distilled insights.
Right. So today we're taking a deep dive into the latest consumer price index, the CPI numbers from August 2025. And this isn't just about rattling off figures. It's about understanding the pulse of the economy and what it actually means for you. Whether you're getting ready for a big meeting, making personal finance choices, or you just want to be truly ahead of the curve, we're going to unpack what the Bureau of Labor Statistics and analysts from places like FX Street and Seeking Alpha are really telling us.
Yeah, we've gone through the data, the expert takes, to give you a concise but still comprehensive picture, hopefully give you the clarity you need.
And here's a little preview, a takeaway tease.
Yeah.
If you were hoping for a big cool down in inflation, August might feel a bit disappointing. It's certainly not an economic disaster, but it does reveal that inflation is proving, well, far more stubborn than many hoped. It seems to be digging in its heels.
Yeah, stubborn is definitely the word.
Okay, so let's get into it. This latest chapter in the economic story, the August 2025 CPI data is out. And the numbers, well, they paint a nuanced but definitely persistent picture.
Right.
When we look at the year-over-year headline inflation, that's the big one. Measuring prices compared to last August for, a whole basket of stuff, it ticked up to 2.9%.
Which is a slight increase from July's 2.7%.
Exactly. It might seem small, but in these reports, every tenth of a percent, it tells a story, doesn't it?
It absolutely does. And what's perhaps more telling about the immediate momentum is the month-over-month change. On a seasonally adjusted basis, the CPI rose 0.4% in August.
And that seasonally adjusted part is key, right? It smooths out the predictable ups and downs, like summer travel costs.
Precisely. It helps us see the real underlying trend. And this 0.4% increase, well, it's a noticeable jump from July's 0.2% rise. It suggests inflationary pressures aren't just holding steady, they might be picking up a little speed again.
That acceleration is definitely something to watch. Now, let's talk about core CPI. For anyone less familiar, this is the number that strips out food and energy prices because they can be so volatile.
Right. Things like geopolitical events or bad weather can swing those wildly. They don't always show the long-term trend.
So core CPI gives us a clearer look at the underlying inflation, often driven by stickier things like services and wages.
Exactly. Those tend to be better long-term indicators. And this figure, core CPI, came in at 3.1% year over year. That held steady with July.
Okay, steady year over year, but month over month.
Month over month, core CPI also saw an increase, up 0.3%.
So still rising month to month, even if the annual rate held.
Yeah.
Okay, so what specific things are pushing these numbers up? Where's the pressure coming from?
Well, if we look under the hood, the main drivers are things hitting households directly. Shelter costs, for instance. They climbed 0.4% just in the month of August. That was the single biggest contributor to the overall inflation increase.
Shelter again.
Shelter again. And what's tricky here, and often misunderstood, is that shelter, especially that owner's equivalent rent part, it's usually a lagging indicator.
Meaning it reflects past price increases.
Exactly. Even if the housing market or new rents are starting to cool off now, the CPI figure still reflects earlier hikes. It acts like an anchor, really, pulling the average up.
That's such a critical point about shelter lagging. So even if things feel slower in housing, the CPI won't show it for a while. But it wasn't just shelter, was it? My grocery bill certainly felt higher.
Oh, indeed. Food prices overall saw a 0.5% increase month over month. And if you break that down, food at home, that's your groceries, was up 0.6%.
Wow, 0.6% in 1 month for groceries.
Yeah.
Yeah, you feel that.
You absolutely feel that at the checkout, don't you? Meanwhile, food away from home, like restaurants, that increased by 0.3%. These are costs everyone faces daily, so these numbers feel very real for your budget.
No kidding. Okay, let's switch gears a bit to energy. That's often the wild card, causing big swings in the headline number. How did energy look in August? Was it expected, or were there surprises pushing the overall index higher?
That's a great question. And yes, energy definitely played a part in August's uptick. Energy costs rose 0.7% overall for the month.
Okay.
And gasoline prices specifically jumped 1.9% month over month.
Ouch. Yeah, we saw that at the pump.
We did. And it's not entirely a shock. Global oil prices have been under some upward pressure lately. Supply concerns, pretty strong demand. So whether it's driving your utility bill or just the cost of transporting goods, those energy price hikes feed directly into the broader inflation picture.
Okay, so those are the hard numbers and the components driving them. We've got shelter being sticky and lagging, food prices still climbing, and a notable jump in energy. So how are the financial analysts, the folks at FX Street and Seeking Alpha, how are they reading all this? Are they surprised by these upticks, especially since the story was supposed to be inflation cooling off?
Well, that really gets to the question of market expectations. And the answer is a bit mixed. Many analysts were indeed a bit surprised, or at least cautious, because that 0.4% months-over-month headline increase, it was higher than some forecasts.
Oh, okay.
Analysts at FX Street, for example, they were quick to point out this acceleration. They saw it as a sign that those disinflationary forces are struggling to really take hold. They viewed it pretty clearly as inflation still having some upward momentum, not steadily slowing down like everyone hoped.
Right, so not just a blip, but actual momentum.
Yeah.
But were there any different takes, more optimistic views maybe?
Yes, definitely. While many focused on that negative surprise in the headline number, some analysts, like those at Seeking Alpha, took a more measured approach. They acknowledged the acceleration, sure, but they also highlighted that core inflation, the year-over-year number, held steady at 3.1%,
Okay.
which suggests that inflation isn't dramatically worse across the board, even if it's not getting better as fast as we'd like.
So kind of a glass half full versus half empty situation.
Sort of. They might argue that while the path down is bumpy, the underlying trend could still be generally downwards, just very slowly. For them, it's a mixed signal. Not a disaster, but certainly a stubborn refusal to cool down quickly. They want to see broader disinflation, and August just didn't deliver that clearly.
That phrase, stubborn refusal to abate, that really captures the challenge here, doesn't it?
It really does.
So what does this all mean for the Federal Reserve? They're trying so hard to bring inflation down to that 2% target without causing a recession, that whole soft landing everyone talks about. These numbers must make their job even trickier, especially thinking about interest rates.
You've absolutely nailed the central problem for the Fed right now. This report, it seriously complicates their path forward, particularly when it comes to any thoughts of cutting rates. Inflation coming in harder than expected, showing that stubbornness. It just gives the Fed much less wiggle room to ease up on monetary policy.
Because if they cut rates too soon.
Exactly. If they cut too soon or too much, they risk pouring fuel back on the inflationary fire they've worked so hard to put out.
But it's not just about inflation, is it?
Yeah.
They have to look at the whole economy.
No, it's not simple. They have to weigh this persistent inflation against everything else. And recently, we have seen some reports showing pockets of maybe weaker labor data,
Oh?
which could counterbalance these inflation worries, suggesting the economy might be slowing down in other ways. So the Fed has to balance these conflicting signals. Yeah. Stubborn inflation here, but maybe some economic softness over there. It really puts them, well, between a rock and a hard place, like walking a tightrope.
Yeah, walking a tightrope with no safety net, it sounds like.
Yeah.
Okay, so if we pull all this together, the BLS data, the different analyst views from FX Street and Seeking Alpha, the tough spot the Fed is in, what's the big picture for you, for our listener, to take away from this?
My take, looking across these sources, is pretty clear. This isn't some kind of disaster scenario unfolding.
Okay.
But it's definitely not the widespread cooling off many were hoping for. Inflation remains stubbornly tenacious, maybe even sticky. That rise in the month-over-month headline CPI, that 0.4%, shows that cost pressures, especially in basic areas like food and shelter, are still hitting household budgets. It's directly impacting your wallet, your purchasing power.
Right. The cost of living challenge continues.
It absolutely does.
And the core CPI just staying steady while maybe not accelerating year over year, that doesn't really give the Fed a green light either, does it? It's almost like a frustrating stability.
Not at all a green light. The fact that core CPI held steady instead of surging higher, that's somewhat comforting. It suggests inflation expectations aren't completely running away, which is good.
Okay.
But on the other hand, it means the Fed can't feel confident yet that inflation is truly smoothly heading back down to their 2% target. They need more solid, consistent proof of deceleration, especially in those sticky service areas.
And this report didn't give it to them.
This report did not provide that clear proof. So for you, the listener, this likely means the environment of higher interest rates impacting mortgages, loans, everything is probably going to stick around longer than some might have hoped just a few months ago.
So Boiling it down, the August 2025 CPI data tells us inflation isn't getting dramatically worse, but man, it is proving stubbornly persistent. And that makes the Federal Reserve's next moves really, really tricky.
That's it, exactly. It's a marathon, not a sprint, back to price stability.
Right.
And the value here for you is that hopefully you now have a clear, concise grasp of what these complex numbers actually mean. You can understand the nuances quickly, efficiently, without getting lost in the jargon. You can engage with these conversations now with real insight.
Absolutely. You're now well equipped to understand the chatter around these figures and what they really imply. And just before we wrap up, here's a thought provoker for you to chew on. Given these persistent inflation numbers, especially in everyday costs like food and shelter, what other, maybe less obvious economic factors or even shifts in consumer behavior might also be feeding this stubbornness, things we aren't focusing on enough?
Hmm.
Are there maybe subtle micro trends happening perhaps in local job markets or little supply chain tweaks, or even just how people are choosing to spend their money that could snowball into bigger macro headwinds if we keep overlooking them? Something to think about as you navigate your own economic world.
That's a great question to ponder as we keep trying to make sense of these economic currents.
Thanks for joining us for this deep dive. We really hope this helps you stay informed and stay ahead of the curve.